could a biotechnology company, one that was basically staring down the barrel of collapse, and it's still viewed with just deep skepticism by the market, could it actually be hiding significant value, maybe even asymmetric value?
It's a fascinating question, isn't it? Because that's exactly what we're looking at today.
Yeah, it's the kind of situation that really grabs your attention. We think the answer might actually be yes.
It definitely has the makings of a turnaround story, but with some really unique biotech twists. The market's lack of trust, you can almost feel it, right? But our analysis suggests there might be some real upside hiding just beneath the surface.
Absolutely. So today we're doing a deep dive into Novavax Inc. The ticker is NVAX. And this company, it's truly at a critical point, an inflection point, really. Our mission here is to unpack a pretty comprehensive research report we've been working on, pull out the most important insights for you.
Yeah, we're going to look at its pretty radical strategic overhaul, how its financial profile has been de-risked, and, tackle that profound market skepticism head on.
Exactly. We want to help you understand the core drivers, the significant risks involved, and there definitely are risks, and ultimately what the market might be missing with that current share price. As of yesterday's close, July 17th, 2025, it was $6.96 a share.
Okay, let's get into it.
All right, let's start with Chapter 1, Business Understanding. Because I think to really get a handle on Novavax in 2025, you absolutely have to see it as a company going through a profound and, frankly, necessary transformation.
That's the perfect word for it, necessary. It's pivoted, dramatically,
right,
from this high-burn, vertically integrated company that nearly went under,
right,
to a much leaner, capital-efficient, R&D-focused organization.
And it's interesting you mentioned that pivot because they've really shifted away from trying to do everything themselves, especially the resource-heavy, ultimately unsuccessful solo commercialization of their COVID-19 vaccine.
Exactly. The new focus is all about maximizing their technology platform. They're doing that through disciplined internal pipeline expansion, sure, but critically throughout licensing, giving partners the reins.
So disciplined and capital efficient, that's the new mantra, essentially, making smarter, lower-cost bets on the programs with the highest potential value.
Right. And the idea is to partner these assets off once they hit proof of concept. That way, they shift the, frankly, huge financial burden of late-stage development onto partners.
That's a massive strategic shift. It's not just talk either, is it?
Yeah.
They've taken concrete steps.
Oh, yeah, definitely. We're talking a 30% workforce reduction compared to Q1 2023. That's significant. And they sold off their manufacturing facility in the Czech Republic to Novo Nordisk for $200 million.
Wow.
And that sale alone, it cuts their annual operating costs by an estimated $80 million. So it directly tackles those past issues with, trying to do everything in-house and burning through cash like there was no tomorrow.
Looking at all this, the real game changer, the absolute linchpin of this new strategy, it really seems to be that Sanofi partnership.
It absolutely is. I mean, that co-exclusive licensing agreement, the CLA they signed back in May 2024, that's the cornerstone. Sanofi is taking over the lead commercial responsibility for Novavax, their COVID vaccine, starting in the 2025-2026 season.
And the financials of that deal, they seem pretty complex, but also kind of crucial to understanding their stability now.
They are complex, but the key insight, really, is how it diversifies and de-risks their revenue. It's not just about the immediate cash injection, although that was vital. It sets up predictable royalty streams and potential future milestone payments.
Okay, so can you break down some of those payments for us, just the key ones?
Sure. So they got $500 million up front in 2024. That was huge. Then another $175 million milestone hit when the FDA approved the BLA, that's the Biologics License Application for Novavax Ovid, in May 2025. That's basically the green light to sell. Plus, there's another $50 million combined expected later this year, Q4 2025, for transferring marketing authorizations. And then looking forward, you've got royalties, high teens to low 20% on ongoing net sales of the COVID vaccine.
Right.
They also get cost plus reimbursement for supplying the vaccine itself for a bit. And then there are potential future milestones up to $350 million tied to their combination COVID-influenza vaccine development and launch, and up to $200 million per new product that uses their Matrix-M adjuvant technology.
Wow, per product.
Yeah, plus mid-single-digit royalties on those sales for 20 years. And that's on top of existing collaborations with Takeda in Japan and the Serum Institute of India, SII, and SK Bioscience.
So, okay, their core tech The recombinant protein nanoparticle stuff and this matrix M adjuvant, those are really the crown jewels they're looking to monetize now.
Exactly. Both are clinically and commercially validated, which is key. But the matrix M adjuvant, that's particularly valuable. It's saponin-based, and it's been clinically shown to create a stronger, longer-lasting, and broader immune response.
Which allows for antigen sparing, right?
Yeah.
Using less active ingredient.
Precisely. Lower antigen doses mean lower manufacturing costs. And the fact that Sanofi specifically licensed Matrix M, it really validates its standalone value. It suggests this potential toll road business model where Novavax gets paid just for others using its adjuvant tech.
Interesting. And looking at their pipeline right now, July 2025, NVAX is authorized. Sanofi's handling that. The malaria vaccine, R21 Matrix M, is partnered and authorized.
Yeah.
But then they've got these phase 3 assets, the COVID influenza combo, CIC, and a standalone seasonal flu vaccine, and those are still unpartnered.
Yeah, and that's a really important point. Those unpartnered assets, they represent both, significant future opportunity and a critical test of whether this new management team can actually execute on finding partners. Plus, they have a bunch of preclinical stuff, RSV combos, H5N1 bird flu, shingles, C. diff, all potential future licensing candidates down the line.
Okay, let's shift gears. Let's dig into Chapter 2, Economic Moat and Competitive Landscape. Now, an economic moat, for anyone listening who isn't familiar, it's basically a durable competitive advantage, something that protects a company's long-term profits. So what's Novavax's moat built on?
Well, for Novavax, it really comes down to its proprietary technology platform, that recombinant nanoparticle vaccine tech, and especially that Matrix M adjuvant we just talked about.
Yeah, Matrix M keeps coming up. It really feels like that's the most defensible piece of their advantage, doesn't it?
I'd say so, yes. Its ability to boost the immune response, its standalone value, which, again, the Sanofi deal really validated. It positions it almost like a platform within a platform.
A platform within a platform. I like that.
Yeah, it could become this high-margin licensing asset, generating revenue totally separate from Novavax's own specific vaccine products. You could imagine, other vaccine developers wanting to license Matrix M for their products, essentially paying Novavax a toll.
And something else that seems like a real advantage, maybe underappreciated, is the logistical profile. Refrigerator stable, right?
Oh, absolutely. NVAX stores at normal refrigerator temperatures, 2 degrees C to 8 degrees C. That's a world away from the ultra-cold storage needed for the main mRNA vaccines from Pfizer and Moderna.
Which has got to be a huge cost and logistical plus, especially outside major Western cities.
For sure. Think about global markets, developing countries, even rural areas here, places where maintaining an ultra-cold chain is difficult or expensive or just impossible. Novavax's vaccine is just simpler and cheaper to distribute and store, less waste, lower operational costs. It's a material advantage.
Okay, so that leads into their sort of unique market position, this non-mRNA niche. As far as I know, Novavax is currently the only protein-based, non-mRNA COVID vaccine available in the U.S. What does that mean for their market position, do you think? Is it durable?
Well, it definitely gives them a clear appeal to a segment of the public that might be hesitant about the newer mRNA technology for whatever reason. Protein subunit technology like Novavax uses, it's traditional, it's well understood, it's been used for decades in vaccines for things like shingles, flu, HPV.
Right, people are familiar with it.
Exactly. And you can't discount brand recognition either. The pandemic, despite all their struggles, it did turn Novavax into a globally recognized name. They built a significant digital footprint, hundreds of websites, huge increases in engagement online. That's a valuable, intangible asset for future launches or partnerships.
Okay, but let's talk threats. The biotech world has massive barriers to entry, right? FDA approvals taking years and billions, high R&D failure rates, IP protection, the sheer cost of manufacturing.
Absolutely. Those barriers protect established players like Novavax from, random new startups popping up easily. But, and this is critical, we have to remember Novavax almost failed in 2023, not because of a competitor's technology, but because of their own internal struggles with manufacturing and scaling up commercially.
Right. So execution risk is huge, even with a moat.
Precisely. Having a moat is one thing. Executing effectively within it is another.
So the main competitive threat isn't really new entrants, it's the established mRNA giants. Pfizer, BioNTech, and Moderna.
Exactly. It's a classic David versus Goliath situation. I mean, just look at the market caps. Novavax is around, what, $1.1 billion? Pfizer is like $140 billion. Moderna, maybe $12.5 billion.
Huge difference.
Massive. These guys have the first mover advantage, dominant market share, just vast resources. Novavax isn't trying to knock them off the top spot. They're aiming to carve out and defend a strong, profitable niche.
All right, let's move into Chapter 3. Management, governance, and capital allocation, because it really feels like at the end of the day, an investment in Novavax right now is fundamentally a bet on this new management team. Can they actually execute this difficult pivot?
It absolutely is. You've got John C. Jacobs, who came in as president and CEO in January 2023, and he stepped into what, by his own admission, was an existential crisis. The company was literally warning it might not survive.
Pretty stark. What's his background?
Solid. 25-plus years in big pharma, Pfizer, Wyeth, Teva, and notably, before Novavax, he was CEO of Harmony Biosciences, where he led them through their IPO and their first product launch. So he has relevant turnaround and launch experience.
And his actions since arriving seem pretty decisive. Radical cost cuts, right?
Oh, yeah. Immediately. Plan to right-size the company, that 25-30% workforce reduction we mentioned, consolidating facilities, and an explicit goal to hammer down R&D and SG&A expenses, selling general and administrative costs to between $475 and $525 million for 2025.
Which is a massive drop from previous years.
Huge. Down from $1.2 billion in 2023, $1.7 billion in 2022. It shows how serious they are about controlling cash burn. And of course, he engineered that fundamental shift towards strategic partnerships, which led directly to that transformative Sanofi deal.
Has he brought in his own people? Reshaped the team?
He has. Key appointments like Ruxandra Dragia-Ackley heading up R&D, Mark Casey as chief legal officer. It signals alignment around this new, leaner, partnership-focused strategy.
Okay, what about the board? And shareholder alignment, are they all pulling in the same direction?
The board's been refreshed, too. You've got members like Charles Newton, deep expertise in healthcare investment banking, Rick Rogers, who's on other public biotech boards. Experience that seems relevant. Now, overall insider ownership is pretty low, just over 1%.
Okay.
But there is a significant signal of confidence recently. Several independent directors, Rachel King, Richard Douglas, David Mott, Rick Rogers, they made open market purchases of Novavax stock, bought shares at $6.42 on June 20th, 2025, right after the Sanofi deal was announced and the BLA got approved.
Oh, that's interesting, putting their own money in.
Exactly. It's a tangible sign they believe in the turnaround plan.
And the overall capital allocation strategy, it sounds like they're basically on a wartime footing. Survival first.
That's a good way to put it. The focus is survival, stabilization, and then generating future value through really targeted R&D. That R&D spending has been slashed dramatically, like we said, from over $1.2 billion down to under $400 million last year. And it's now focused on early-stage work with the clear goal of out-licensing later.
So things like M&A, dividends, share buybacks, those are off the table for now.
Completely off the table, de-emphasizing M&A, no dividends, no buybacks. It's all about preserving capital during this turnaround. So yes, this framework makes it crystal clear. Investing in Novavax today is fundamentally a bet on this management team's ability to navigate a complex situation and actually monetize the assets they have.
Okay, let's pivot to the numbers in Chapter 4, financial analysis. And I think it's really crucial here to emphasize that looking at Novavax's historical financials in the conventional way, well, it's just not that helpful, is it? Because of the extreme volatility and this massive strategic shift.
You're absolutely right. You're almost looking at two different companies. Historically, you saw this classic pandemic boom and then bust. Revenue shot up from almost nothing, like $19 million in 2019, to a peak near $2 billion in 2022. That was all driven by those COVID-19 advanced purchase agreements, the APAs.
Right, big government contracts.
Exactly. But then it fell sharply, down to $682 million in 2024 as those dried up or were renegotiated.
And even with those huge revenue numbers during the peak, they were still posting massive net losses, weren't they?
That's the killer point. Despite billions in revenue, they lost, what, $1.74 billion in 2021? Even in 2024, they lost $187 million. It just underscores how unsustainable that previous high-cost, vertically integrated strategy really was. They were spending huge amounts on R&D and trying to build out manufacturing and commercial operations.
So when we look at profitability, I saw they reported a big net income number in Q1 2025, like $519 million. What's the story there? Is that real?
Yeah, that's a perfect example of why you need to dig deeper. That Q1 profit was overwhelmingly driven by a one-time accounting event. They recognized $603 million in deferred revenue from advance purchase agreements that were terminated, mainly with Canada and New Zealand.
Ah, okay. So it wasn't from selling vaccines or sustainable operations.
Not at all. It's crucial for your listeners not to be misled by that headline number. It doesn't reflect underlying ongoing profitability.
Got it. So metrics like return on invested capital, ROIC, historically they've been negative, basically showing value destruction. And I guess it's not even meaningful when invested capital itself is negative due to accumulated losses.
Precisely. It just highlights the flaws of the old strategy. The absolute core task for the new management team is to flip that script, to drive future ROIC above their cost of capital with this new, leaner, capital-light model.
But there are some green shoots, right? The balance sheet health, liquidity, that's looking better.
Yes, definitely. Despite the history of losses, management's actions have significantly improved the liquidity situation. As of the end of March 2025, they had about $747 million in cash, equivalents, and marketable securities. And that's going to be further boosted by those Sanofi milestone payments coming in.
And they've reduced debt
Yeah.
or liabilities.
Yeah, they've deleveraged quite a bit. Total current liabilities were slashed from over $1.1 billion at the end of 2024 down to $422 million by the end of Q1 2025. That's a big improvement.
Okay, but there's still that negative shareholder equity figure lingering, like negative $76 million as of March 31st. Some people might see that as a big red flag.
It is technically an accounting red flag, but you have to understand why it's negative. It's basically an artifact of the huge accumulated deficit from years of heavy R&D spending and operational losses before the pivot. For a forward-looking investor, the company's future earning power from partnerships and its path to sustained positive cash flow are much more relevant than that historical accounting number.
And on that front, the company's guidance for 2025 looks more encouraging.
It does. They raised their revenue framework for the year to between $975 million and $1.025 billion. Now, that includes those one-time APA termination revenues and the Sanofi milestones. You have to keep that in mind.
Right.
But critically, they also projected a really tight combined R&D and SG&A expense base, remember, $475 million to $525 million. That combination signals a clear, credible path towards potentially achieving positive operating cash flow for the full year 2025. That would be a major milestone.
Okay, now for maybe the most crucial part for potential investors. Chapter 5, Risk Assessment and Headwinds.
Yeah.
We always stress taking a really rigorous, skeptical look at the risks. What are the big ones listeners need to be aware of with Novavax?
Yeah, absolutely critical. So while the new partnership strategy lowers capital needs, it creates a huge dependence on those partners, especially Sanofi right now. I mean, any delays, any operational hiccups, or simply lower than expected commercial sales by Sanofi, that would directly hit Novavax's bottom line.
So partner execution risk is number one.
I'd put it right up there. And tied to that, their longer-term success really hinges on securing more partnerships. For those phase 3 assets, the CIC and influenza vaccine, and eventually the preclinical stuff, if they fail to land those deals on good terms,
Then they're stuck either trying to fund costly late-stage trials themselves, which they probably can't afford without dilution, or shelving potentially valuable assets.
exactly. It puts a lot of pressure on management to deliver on the partnering front.
Then you've got the standard biotech risks.
Yep.
Regulatory, clinical hurdles.
Always present. Every pipeline asset carries the risk of clinical trial failure. We saw a reminder of that in October 2024 when their CIS influenza phase 3 trial was put on a clinical hold, right? It was eventually lifted, but it highlights the inherent uncertainty.
Yeah.
But with Novavax, there seems to be this added layer of, well, political risk now, doesn't there?
That BLA approval controversy was quite something. Allegations of political interference from former government officials causing delays, maybe leading to a more restrictive label.
Right. And whether those allegations are true or not, it points to a systemic, unpredictable political risk that's kind of outside the company's direct control. That definitely warrants a higher risk premium when you're thinking about valuation. And of course, we can't forget the existing warning on the new Vaxovid label about rare risks of myocarditis and pericarditis. That's always going to be a factor in uptake.
Okay, and what about market sentiment? Novavax seems like a stock people either love or hate. Very polarized.
Extremely polarized, which creates a high-risk, high-volatility trading environment. And you see that reflected most starkly in the short interest.
Yeah, that number is eye-popping. 34.07% of the public float shorted as of July.
It's exceptionally high. It tells you there's a very large, very vocal contingent of the market actively betting on this company failing. It stems from that deep trust deficit we talked about, a legacy of past execution failures, manufacturing issues, lawsuits. It creates constant selling pressure on the stock.
And the analysts can't seem to agree either, right?
Hmm.
That range of price targets is huge.
Absolutely. Wall Street targets range from, $6 on the low end to $25 on the high end. That just screams profound disagreement about the company's future prospects.
Finally, any big macro or geopolitical factors to consider?
Well, the broader biotech industry context isn't exactly easy right now. Higher interest rates, persistent inflation. That generally makes capital harder to come by and investors more risk-averse. While the Sanofi deal gives Novavax a cushion, a worsening macro environment could make finding those future partners more challenging.
Any impact from things like tariffs?
Potentially. Those new 2025 U.S. tariff policies, the baseline 10% on many goods, while pharmaceuticals often have exemptions, it could increase raw material costs across the industry, potentially squeezing margins down the line. It's something to keep an eye on.
All right, let's try and put a number on this. Chapter 6, valuation, determining intrinsic value and margin of safety. Now, as we've said, looking at traditional metrics like the PE ratio for Novavax, it's basically useless, right, because of the history of losses and those one-off profits.
Completely useless. You absolutely need a forward-looking approach here. We have to project future cash flows based on this new strategy and then discount them back to today's value. So we use a scenario-based discounted cash flow or DCF analysis.
Okay, and you model different scenarios to capture the range of possibilities.
Exactly. We built out three main scenarios. Our base case represents what we see as the most probable path forward. It assumes the Sanofi partnership plays out successfully. They hit those near-term milestones, they get steady royalties, even as the endemic COVID market gradually declines. And critically, it assumes they do successfully partner that Phase 3 CIS influenza program in 2026 on decent terms.
Okay, that sounds reasonable. What about the upside, the more optimistic view?
That's our bull case. Here, we imagine Sanofi's commercial efforts are stronger, leading to higher royalties than in the base case. But the real driver in the bull case is broader monetization of that Matrix M adjuvant. We assume Novavax manages to sign, say, 2 additional major licensing deals for Matrix M with other big pharma companies over the next 5 years. That really unlocks the platform within a platform value potential.
The toll road model.
Exactly.
Right.
And then, of course, you need the downside scenario.
The bear case. What happens there?
The bear case is basically where those key risks we just discussed actually materialize. Maybe there's friction with Sanofi, delays, maybe COVID royalties dwindle to almost nothing, but the absolute killer assumption in the bear case is that they fail to secure a partner for the CIC and influenza programs. That would likely force them into costly internal development, probably requiring significant shareholder dilution, or they'd have to just shelve the programs entirely.
Okay, so you ran the numbers on these 3 scenarios using a DCF model. What kind of discount rates did you use, given the risk?
We used pretty high discount rates to reflect that risk profile. 14.0% for the bear case, 12.0% for the base case, and still a relatively high 10.5% for the bull case. And we used a conservative perpetual growth rate of 1.5% across all scenarios for the long term.
And the output. What implied intrinsic values per share did the model spit out?
Based on that analysis, the implied intrinsic value ranges came out as $4.50 per share for the bear case, $15.25 per share for the base case, and $28 per share for the bull case.
Wow, okay. That's quite a range, but that base case number is interesting. So let's talk margin of safety, applying Warren Buffett's principle. The market price, as we said, was $6.96 yesterday.
Right. So comparing that $6.96 market price to our base case intrinsic value estimate of $15.25, well, the current price is significantly lower. It implies a potential upside of over 119%, which suggests a very substantial margin of safety, around 54%. Now, clearly, the market price is still above our bear case value of $4.50, so there's definitely downside risk if things go wrong. But the risk-reward profile, based on these numbers, looks highly asymmetric to the upside. It really seems like the current market price is baking in a very high probability of failure, despite the tangible progress the company has made under this new leadership and strategy.
Okay, let's wrap this up then with Chapter 7, Conclusion and Recommendation. To recap, Novavax presents as a really compelling, but definitely high-risk, special situation investment opportunity right now.
Agreed. They've successfully executed a major strategic pivot under John Jacobs, transforming from that cash-burning behemoth into a much leaner, capital-efficient R&D and technology licensing company. That pivot seems real.
Key strengths. That Sanofi partnership stands out as a critical financial lifeline, providing a more predictable revenue path, at least near term. And that Matrix M's event feels like a durable, maybe underappreciated competitive advantage, that potential toll road.
But the challenges are undeniable, too. There's that legacy trust deficit with the market reflected in the high short interest and the stock's volatility. There's the heavy dependence on the Sanofi relationship working smoothly. There are the inherent clinical and regulatory hurdles common to all biotechs. And now, this emerging kind of unpredictable political risk surrounding the FDA reviews.
Financially, though, it's a company clearly in transition, but the balance sheet is stabilizing, and there appears to be a credible path to sustainable positive cash flow, possibly starting this year.
And our valuation analysis suggests the market is heavily discounting the probability of success for what looked like a well-defined turnaround plan. That base case intrinsic value of $15.25 per share implies that significant margin of safety at the current price.
So, based on this whole analysis, weighing the potential rewards against those considerable risks, the recommendation comes out as a buy.
And maybe a final thought for you, the listener, to chew on. Given this ambitious turnaround effort by Novavax, and given the market's really entrenched skepticism, what specific tangible progress, or maybe what new development would you personally need to see from Novavax's leadership to fully believe they've actually rebuilt that market credibility and are truly ready to unlock the value of their technology platform? Something to think about.
Great point. And if you found this deep dive valuable, please do consider liking and subscribing to Stock Analytics AI. For just $4.99 a month, members get priority deep dives on specific tickers you request. We're planning to cover all of the S&P 500 stocks over the next few months, and members get exclusive priority access to those analyses.
And if you just want a one-off deep dive into a company that interests you, you can always drop us a super thanks.
Just please remember, this deep dive was generated using our AI research tools. It's strictly for informational purposes and should absolutely not be taken as financial advice. Always, always conduct your own thorough due diligence before making any investment decisions.